Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, February 18th, 2023, and thank you so much for coming by and watching another episode of my Weekend Review podcast. I hope you're doing well, hope you're trading well, hope life is going well. Today, the format of this podcast is going to be as follow. First of all, we are going to run the U.S. legal disclaimer. Secondly, we are going to come back. We're going to take a look at all the positions that I've been trading last week. I trade both on the daily time frames and also the weekly time frames, and I'm going to show you all the trades that I got in. Some of them I'm out for losses, some of them I'm out for gains, some of them I still have the positions, but we're going to talk about when I bought the position, why I bought the position, and most importantly, how I am going to manage the position going forward. I trade 5 different types of trading strategies. Each one of the strategies has different rules. So in this podcast, I will do my best to explain why I am doing what I am doing. However, if you would like to learn step by step how I trade and how I trade these 5 different approaches, I do offer private one-on-one lessons in the evening time via Skype. I teach a 15-hour course, 5 sessions. Each session is 3 hours long, and I will take you through step by step how to trade each 5 of these different approaches and all the rules that go along with them. I have taught students from all over the world. I've been doing this for years, and if you really want to learn the skill of trading, I can teach you. I love to teach, and it's very important to me that my students succeed as traders, and that's what you will get if you take my course. So in the link of this description, I do have my email. All you have to do is email me, reach out to me, and we can get the process started, and I'll talk a little bit more about this as we go through the podcast. So that's it. Then after I take you through the trades that I've taken this particular week, we're going to spend a few minutes on trader psychology. Always the most important skill in trading is the ability to create a plan, follow that plan through without letting emotions take over, and that's the downfall of a lot of traders, is not following their process. And so I like to talk about trader psychology, like to touch on that in each podcast because it is the most important skill you can learn. And hopefully by me talking about it, it does 2 things. One, it explains some things to you, helps you, but it's also helpful for me to teach these things as well. You know, you should teach what you mostly need to learn. And hey, I'm human, right? We all deal with kind of the same demons when it comes to trading. So I have found that it's helpful for my students and people watching the podcast that I talk about the trader psychology, and it's also helpful for me. After that, we are going to do, I'm going to read a poem by my good friend Frank, the trading poet. Always has great poems, always pertinent to what's going on in the current market situation. And so we'll touch on that. After that, I have gone down through my master watch list, both on the daily time frames and the weekly time frames. And I have highlighted a few both on the daily and the weekly of potential trades that I'm looking for next week. And usually I need the stock price to go up and form some kind of pattern that shows me that it's a momentum pattern that might keep moving up, or conversely, I need the price to go down, reject a certain type of level. So I have more than a handful, both on the daily and the weekly, of what I'm looking for, and hopefully will give you an idea of how I view trading, what the levels I'm looking for, how to position size correctly, how to manage the trade. So hopefully that will be helpful for you. All right, so first of all, I have to run the U.S. legal disclaimer, and then I'll be back in about 40 seconds. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right. Thanks so much for holding through that with me, and let's get going. These are the trades that I took action on last week. All right. First of all, MasterCard, symbol MA. I did buy MasterCard back here on the 13th of February because what we have here is called a return to value V2. That was the entry trigger. A return to value means you're above the value zone. The green line here, that's the top of the value zone. The green line here is the bottom of the value zone. Any place in here is the value zone. And you want to buy in value and sell above value, or you want to buy below value and sell in value. What you want to get away from is chasing these moves up here that are above value. In general, it's just not a good idea to buy above value because very often when you get up here to this third ATR channel, prices come back, which is exactly what they did. And a lot of retail traders are going to buy up in these kind of areas. And then when it comes back in here, they're usually going to get out, which is about the opposite. You want to be looking to buy in the value zone and sell above value zone. So a return to value means that the price was above the value zone, or the green line. It came back into the value zone. It consolidated, moved sideways, and then created a V1 or a V2. This is a V2, bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low and then closes above bar 1's close. That was the entry. Now, in any particular trade that I take, I always have two stops. I have an emergency stop and I have an end of day stop. And the emergency stop is always going to be the value of 2 ATRs below your entry. And I took a new trade this week on silver, and I will show you step by step exactly how to do the math of how many shares I buy and where the end of day stop is, where the emergency stop is going to be. But in this particular case on MasterCard, here's the V2. Triggered the V2 after the sideways motion, after the return to value. So 2 ATRs below is my emergency stop. The end of day stop on a V2 is just going to be a close below halfway of this washout bar, the bar 2 bar. So I bought it here at 370.43. Emergency stop, 2 ATRs below. End of day stop, close below halfway of the washout bar. Well, next day went up a little, came back down. The next day after came down, tested halfway of the washout bar. But I base everything on the closing price. And so during the day, it went below, but closed above. That kept me in the trade. The next day, opened below, kept me in the trade. But Friday, it did finally close below halfway of this washout bar. So I had to take a loss on the trade of 2.59%. You know, the last 3-4 weeks, no losses hardly at all. So, but this week, the market has changed a little bit, and that's just how it goes. Not every setup works. And by the way, if you're interested in learning more about V1s or V2s, I have a free video in my YouTube channel under the playlist called V1, V2 entries. Go and watch it. A lot of people have watched that, a lot of good feedback on that, and it will show you what I'm doing here. So anyway, this one did not work out, had a loss of 2.59%. VIX, had a really nice trade on VIX back here on the 2nd of February. And this is a different strategy. This is a deep dip buy strategy where intraday we went under the 30 RSI, closed back above the 30 RSI. That was the entry trigger. We also had a V1 here, not the reason I took it, but anytime you have a trade, a major trade like an under 30, over 30, I always like to look for other confirming signals like a V1 or a V2, and this is exactly what I got. So I bought VIX here with the under 30, over 30 at 11.17. Now my emergency stop is down here 2 ATRs below, as I mentioned earlier. And then my end of day stop is just going to be simply a close below a close below a 30 RSI. So if I took the trade because it went under 30, over 30, then my end of day stop would just simply be a close below 30. 30 RSI is an important level where a lot of buyers come in. In addition to the under 30, over 30, and the V1, I also had a rejection of the negative third ATR channel. This is important because 92% of prices tend to stop going down when you get to the negative third ATR channel and bounce. So that's the rationale of why I decided to buy this to get long VIX. So I got long VIX here at 11.17. You see the orange line up here. This is 1.5 ATRs above my entry. If when I enter a position and it gets 1.5 ATRs above my entry, then I go into what is called trailing stop mode. So emergency stop 2 ATR below, trailing stop level 1.5 ATRs above. And in addition to that, whenever the market moves up 0.45 ATRs, or the value of 0.45 ATRs above a previous bar's close, I get out of a portion. I like to play offense and defense in my trading. Defense, end of day stop, emergency stop, trailing stops are also considered defensive, but scaling out and into strength is offense. And with any good sports team, you need offense and defense to win. And I believe it is the same way in trading. So entered here, 11.17. Next day moved up, hit some profit targets, took some profits off. This day here, hit 2 profit targets. Next day here, another profit target. So I'm scaling at profitable levels as the market in VIX, in this case, is moving my way. Now, on this day, on the 9th, got to the 1.5 ATR trailing stop level. So now I go into trailing stop mode, which means if I have a close below a previous bar's low, I will get out of half. Earlier, I was telling you about different trading strategies with different rules. Well, if I take an under 30, over 30, and I reject a 50 RSI, then I also get out of half. Well, this bar went above 50 RSI and then closed below. So I took off half of the position because that was a bad signal that it rejected the 70 RSI. So I took off half. I took off half here at 12.22, the first half, for a gain of roughly 8.3%. So that was a really great trade. Took that off. And then the next day we had a close below the previous bar's low. That was my signal to get out of the second half of the trade. So the first 8.3, whatever. And then this second half I got out of with a gain of 4.36. So really nice, profitable trade, just simply using the signals that I use and that I teach. And then the next couple days we went down and we went down, and I was sure glad I was out of the trade. And then of course the last couple days we rallied again. But done with the trade on VIX. Very, very profitable one. That was a great trade. Thank you, VIX. UNG. All right. UNG. I took this trade back on the 6th of February. Why did I take it? Under 30, over 30, V2, rejection of the negative third ATR channel. Lots of different signals coming here. I position sized. I have my 2 ATR stop below, my emergency stop, and then my end of day stop. Well, my end of day stop, you have to think to yourself, why did I take the trade? I took the trade because it went under 30, over 30. Therefore, in the future, if it closes back below 30, I would get out. Next day, moved up, took some profits, thankfully, right? Using the offensive approach. Took 10% off here, came back down, had another nice bar up, took some profits again at profitable levels, then back down. Next day, up again, took more profits off, and then we've moved back down. I'm still in the trade, minus 30% of the trade, luckily, that it's at profitable levels, but now still in the trade because we're at 32.34. If Tuesday, because Monday's a holiday, if Tuesday closes below 30, I'm just going to have to get out of the trade for a loss. Or alternatively, if it gets to my emergency stop, I'm going to get out. And with an emergency stop, I get out whenever that happens. Normally, I wait for the end of the day to make my buying and selling decisions, but there is one exception, and that's if it hits my emergency stop, then I'm just completely out. And I took a new position on silver on the weekly today, and I will show you step by step exactly how I do the position sizing, place everything, but don't want to spend the time on every single one to go through, but I will on silver. So this one currently is a loss of 8.75%. So fairly big loss on that. But don't let the big numbers confuse you. It's not like I lost 8.75% of my total capital. Even if I got to my emergency stop, I would only lose 1%, but I'll show you how to do that. So loss of 8.75% on UNG. Pfizer. Took Pfizer here. This is a different approach. A higher low under 30 over 30 while MACD is green. Got long here, 43.46. Placed my emergency stop down here. Placed my trailing stop level up here. Next day moved up. Took some profits off. A couple days later, up again. Took some more profits off. But then we have gone back down. But it has not reached my emergency stop level. And it has not closed below the 30 RSI, which my end of day stop. But nonetheless, this particular trade down about 0.56%. CCJ. All right. Well, I did short. This was a short trade on CCJ. We have a double top here with a bearish divergence, and we rejected the 70 RSI. And again, bearish divergences, all these kind of things, 70 RSIs, this is what I teach in my private one-on-one lessons. But I like the double top with the bearish divergence. I like that we rejected the 70 RSI. And you can see up here is my emergency stop level. My end of day stop is simply a close back over the 70 RSI. Next day went down, went the direction I wanted it to, took off 10% at profitable levels. So I was thankful for that. At least it got something positive and it reduced my risk if I did stop out. And I did stop out on the trade 2 days later when it closed back above 70 RSI, and then it went right back down. But I did get out. I took a loss on this of 1.02%. All right, and here's the last daily trade. Yeah, the daily trades were tough this week, but the weekly trades still pretty dang good. AGQ. I bought AGQ back here on the 14th of February on Valentine's Day because we went under the 200 on the daily and then closed back above. We also rejected the negative third ATR channel. Really good setup, but not every really good setup works, right? So I position size correctly. My end of day stop was simply a close below the 200-day moving average. And of course I had my emergency stop. Next day, boom, right down, close below, had to take a loss of 2.11%. So those are the dailies, not so hot tamale. Weekly is a lot better. I did short. Now these are the weekly bars. A weekly bar closes on Friday. I make my buying and selling decisions on these at the close of the week or on Friday. I did short QLD, which is double leverage Q, because we went from under the 200, touched it, rejected it, came back down. That's why I got short. I position size correctly. I placed my emergency stop 2 ATRs above, and my end of day stop or end of week stop in this case would simply be a close over the 200-day moving average. So I did get short 46.10. Next week moved down, took some profits off. Last week, well, it was up 30 cents, not much, but still profitable on this trade here. About 4.77% to the short side. SSO. Long SSO, double leverage SPY. I took this back here on the 6th of January. Why did I take it? This is a deep dip buy close, or a deep dip buy setup. We had to close under and then close over the 200-week moving average. Position size correctly, place my emergency stop 2 ATRs below. End of week stop would simply be a close below the 200. It moved up nicely my way. First bar moved up, took some profits. Next bar took some profits here, also took some profits here. And I am in trailing stop mode. You see how we've reached 1.5 ATRs above my entry, or the orange line here. And so now I'm in trailing stop mode, meaning that if and when I get a close below a previous bar's low, I will get out of half. Well, last week at the low, we did go below the previous bar's low, but it closed back above, so I kept the position. This one doing very well, from entry to current price, up 8.53%. IWM. Another deep dip buy, which again is what I teach in my one-on-one courses. Been in this one for a while. Pretty much got the low on the market here back on October 14th, 300 week moving average. The price went under the 300 during the week, closed back over. That was my entry point at 167.19. I position size based upon the current volatility, which I will show you in a little while. And then I place my emergency stop 2 ATRs below my end of week stop, which just simply have been a close below the 300. The risk to reward on this particular trade is very good because even if it closed 1 penny below, I'm out for a small loss. And that's the profitable trading math in trading, is position sizing, having a good risk to reward ratio, knowing what your maximum allowed loss is. But if you're wrong, having a line in the sand or a level in the sand that if you close below, you're out for a small loss. Well, this one did not end up with a loss. This one ended up with a beautiful gain and got long here at 167.19. Got here to my trailing stop level, which means in the future, if I have a close below a previous bar's low, I get out of half. This was the first bar that closed below the low, got out here at 178.70 on the first half for, looks like a 6.37% gain. Of course, as it moves up, I take partial profits. If it moves the value of 0.45 ATRs from the previous bar's close, sold into a lot of strength here, sold into a lot of strength here. We have still not had a close below a previous bar's low, and this particular trade on the second half or the remaining shares up 13.52%. KMX, took some action on KMX here. Now, this is a different kind of setup. This is one of my very, very favorite setups. This is called a higher low V1. I was talking about V1s and V2s. Well, the rules on a higher low is you have to close below the -1 ATR channel, you have to rally into the value zone, then you have to have a pullback and reversal that leads to a V1 or a V2. This is a V1, bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. I have to position size. I have to place my emergency stop 2 ATRs below. And then more importantly, where is my end of day stop? Well, on a V1, end of day stop is simply a close below halfway of the washout bar. Well, this is the washout bar. See the pink line here at $65? That's all I'm giving myself as far as the risk. If it had closed below halfway of this bar, I would have just simply gotten out, or worst case scenario, would have got to my 2 ATR emergency stop. Next week after I bought it, moved up, took some profits. Week after that was a big week. I believe I hit 3 profit targets on this one, so I sold into strength. That particular bar got me to trailing stop level, orange line, and then the next week after did not have a close below the previous bar's low, but this week did have a close. See how we closed below the previous bar's low? That was my signal to get out of half of the position for a gain of 10.3%. So that was really, really good, really good trade. WBA, all right, return to value. Again, different type of setup where we are in an uptrend above the value zone. We come into the value zone. We have to go sideways. We have to have sideways motion for at least a couple bars. Here are the couple bars. And then we have a V2. A V2 is 3 bars. Bar 1, bar 2. Bar 2 has to go below bar 1's low, and then bar 3 has to close above bar 1's close. I position size. I place my 2 ATR emergency stop, and then I have to have my end of day stop. My end of day stop here, halfway of the washout bar, went down twice, but closed back above, kept me in the trade. So I am still in the trade, but slightly down on this trade. Let's take a look here. About 0.35%. Not too bad. But I like that we had another V2 on Friday. So a little down on the trade, but still holding the end of day stop. And then silver was the new position that I took. Why did I take this? Well, I took this trade because of the intra-week rejection of the 200-week moving average. You see how we went below and then closed back above. And, you know, whenever I take a trade, I look at the time frame that I'm trading on, which would be weekly, But I also want to look at the higher time frame, in this case, the monthly, and see on the monthly, did we reject something important? Was there support on the higher time frame? Well, there was. The dotted line here is the 50 EMA. We did test it during the week and closed back above. In addition to that, we have the 200 week moving average here as support as well. So if I take a trade on a shorter time frame like the weekly, which I did because it went under the 200, over the 200, that's the reason I took the trade. But I also look at the higher time frame to see if there's been some levels that have been supported, and there were support of the 50 EMA here, and that's why I took the trade. So as promised, I want to show you exactly how to position size in this particular trade. So first of all, you have to figure out what your maximum allowed loss is going to be on any one trade. It doesn't mean that actually 95% of the time your loss will be an end of week or an end of day loss. It will not be a maximum allowed loss, but you still have to ask yourself, what's my maximum allowed loss? Well, a good rule of thumb is a function of your total capital. Let's say you have a trading account of $100,000. 1% is a good rule of thumb that I use. 1% of $100,000 is $1,000. If you had a $500,000 trading account, 1% would be $5,000, right? If you had a $50,000 trading account, 1% would that be $500. So let's just go with a hypothetical $100,000 trading account. 1% of 100,000 is 1,000. 1,000, I take 1,000, I divide it by the value of the 2ATR. This is factoring in the volatility, and that shows me how many shares to buy. So 1,000 divided by 2.49 tells me to buy 401.6 shares. So I'll just round it up to 402 shares. That's how many shares I'm going to buy if my maximum allowed loss is $1,000. Because if I buy 402 shares and it goes down 2.49, then I lose $1,000. Don't worry about what percentage that is. It's just the dollar amount. Now, is it likely that I'm going to lose $1,000 on this trade? No. It's very unlikely because my end of day stop is simply a close below the 200. So 95% of the time, if I have a losing trade, it's going to just be a smaller loss here. But I have to position size and I have to place my emergency stop in case everything hits the fan, which it does 5% of the time in my experience. So rejection of the 200 was my entry point. I position size by taking my maximum allowed loss, dividing it by the value of the 2 ATR. That tells me to buy, in this particular case, 402 shares. I place my emergency stop down here so that if it does get down there, I will get out and lose $1,000. But unlikely, more likely than that, it moves and closes below the 200. Even if it's a penny, I will get out for a small loss. On top of this, orange line, 1.5 ATRs above my entry. So if it gets there, then I go into trailing stop mode. So that is it. Just a quick recap. MasterCard took a loss of 2.59%. VIX had a 8.3% gain and a 4.36% gain. I am now out of that trade. UNG, not a good one, down 8.75%. Pfizer, not a good one, loss of 0.56%. CCJ, loss of 1.02%. And AGQ, loss of 2.11%. So it was a challenging week for me as far as the dailies go. Weeklies better. QLD up 4.77%. SSO up 8.53%. IWM up 13.52%. CarMax sold half for a 10.3% gain. WBA down 0.35%. And silver, the new trade that I took with the rejection of the 200. All right, let's head over and do a little trader psychology. This is from the Divergent Trader, Alan Edwards. You can follow him at Trader Divergent on Twitter. It's a great channel. He specializes in trader psychology, always has good words, trading words of wisdom to read. I look forward to reading them every day, and I pull from this a lot for the podcast. Please do yourself a favor, follow him at Trader Divergent and read every day. It's always helpful. All right, here we go. Reduce your risk. If your heart is always racing, it's a sign that you have too much size on, or your position size is too large, right? Find the right balance where it's just small enough so you are not fazed by a loss, but just big enough to have something meaningful behind it if you keep alert. And this is really important. And that's why I was just talking about how to position size. Taking your maximum allowed loss, dividing by the value of the 2 ATR is the best way I have found. I've been trading for 28 years. It takes into account the current volatility of the market. If the market's very volatile, this formula will have you trade fewer shares. If it's not volatile, it'll have you trade more shares, and that's the correct way to do it. If volatility, say, is a 1 and you trade 100 shares, but now volatility jumps up to 5, trading that 100 shares is really like trading 500 shares, because the market's 5 times as volatile, and that's why using that 2 ATR will really help you find the correct position size. And a 1% maximum allowed loss, if you're completely wrong on your trade, is a good conservative amount to lose. It's not going to wreck your entire account. And so anyway, just a few words on this based upon what he's saying, but it's a great way to find the right balance, because if you, like he says, if your heart's always racing, it's a sign you have too much size on. It's a horrible way to live, a horrible way to trade. Yeah, it's great if it works your way, but if it goes against you, it can be demoralizing and soul-sucking, right? But you don't want to have a position size on that's so small that it makes no difference to you either. So it's finding the right balance. Find the right balance where it's just small enough so that you are not fazed by a big loss, your 1%, right? Or large enough to have some meaning behind it to keep you alert. So it's a fine balance of not trading too large, not having your heart racing, but still having enough on that it makes a difference if it goes your way and keeps your focus on trading it correctly. You don't want to trade one share of something and you don't really care, right? So using the 2 ATR for your position sizing, I highly recommend it. Again, this is what I teach in my one-on-one courses. Happy to teach you this all, trying to do this here as well. But thank you, the Divergent Trader, Alan Edwards. Really appreciate that. Please follow him at Trader Divergence over on Twitter. All right, let's do a poem real quick, and then we will get over and take a look at some trades for myself for next week. This is Frank. You can follow Frank at FrancoD over on Twitter. The Trading Poet. Do yourself a favor. Always great poems, always pertinent to what's going on. Today's market poem. We all want 1,000 flowers to bloom. A market that's strong and one that can boom. But we don't know the future or the events that will loom. That's why traders make plans and never assume. Yeah, of course, we want all of our stocks to bloom and go up, right? But they don't always do that. And you don't have any control over it, obviously, and unfortunately. But that's why we have to have a plan in our trading. That's why traders make plans and never assume. And it's so true. And, you know, when it comes to trading, what you want to do is you want to look for some kind of support, like the 30 RSI, the 200, the 250, the 300 SMA, V1s, V2s. You want to look for some kind of confirmation in your trading that a level is holding. Then you position size based upon the volatility. You place your emergency stop. You have your end of day stop. You place your 1.5 ATR trailing stop above you. So once you get to that point, you can go into trailing stop mode. You phase out into strength. You know where significant overhead resistance levels are. There's a lot of components to trading. And it's not just as simple as, it's very easy to just buy something, but you have to have a complete plan in place in order to make money in this market. You really do. There's like 10 things you kind of have to know. And again, that's what I teach in my one-on-one course. So one more time, today's market poem. We all want 1,000 flowers to bloom, a market that's strong and one that can boom, but we don't know the future or the events that will loom. That's why traders make plans and never assume. Isn't that great? All right, so as I mentioned at the beginning of the podcast, I did go down through my watch list, both on the dailies and the weeklies, and what I'm going to show you here are the potential trades and levels that I'm looking at for next week. Here we go. Let's start with Apple. Well, Apple's been quite strong. What I'm looking for on Apple is a pullback to this 200 SMA. There should be some buyers that come in there. Doesn't mean if it gets there and rejects it that it has to be a positive trade, but it gives me a good level to key off of. And this is, I'm looking to do this on the daily. And so I drew a line here at the 200-day moving average, and I'll show you why I'm doing that. This line, if I switch over to the weekly, I can see what kind of line the 200 on the daily, what kind of level the 200 daily is showing me on the weekly, because I want to look at 2 time frames. I'm trading the daily, but I'm also looking at the weekly to see if there is some supportive support levels on the weekly as well, and there are. You see the 200 on the daily at 146.90. On the weekly, it also dovetails with the 50 EMA here as support, because there will be some buyers, most likely, on the weekly buyers, that if it comes down to here, will go, oh, it rejected the 50 EMA. I want to buy that on the weekly time frame. And at the same time, buyers should come in here at the 200 as well. So you want to look for multiple level support on multiple time frames. So now, will Apple get down here? I have no idea. And if it doesn't, I'm not going to mess with it. But if it does get down here and rejects that 200, either intraday or it goes below the 200 and closes back above, you bet you I will buy Apple. Or conversely, if it closes below the 200 and then closes above the 200, I would also get in. The 200-day moving average is an important level, especially on a major stock like Apple. And like I said, the 200 moving average here, right about 146.90 on the weekly chart, dovetails with support of the 250, the 50 EMA above. So one of the best things you can do on the weekend is kind of what I'm trying to do here and showing you here. Look for stocks, look for levels. Don't get impulsive or get caught up in the action of it moving. If Apple gets down here, I will buy it. And if it rejects the 200, I will buy it based upon the strong level of the 200, and then based upon that level also being a level on the weekly. So Apple, some kind of rejection of the 200 next week. And if it gets there, great, I'll buy it. If it doesn't, then I won't buy it. Adobe, ADBE. Well, here's the 200-day moving average. We closed below it on Friday, but if we close back above it on Tuesday, because Monday's a holiday, I will enter and have the support of the 200 below me. And if it closes above, I'll enter position size. I'll place my emergency stop 2 ATRs below. Where will my end of day stop be? End of day stop is usually what's the opposite of why you took the trade. If I took the trade because it closed under 200 over 200, then my end of day stop is just simply it closed below the 200. So I drew the line here, 360.80. Let's see where that level, what that level looks like on the weekly bars. Well, weekly bars, here's the support of the 1 ATR channel, and then also halfway of this big bar. Whenever you have a big bar up, it's normal that we can come back down, test that halfway. So if we get back above the 200 on Adobe, we will also get it back above halfway of the bar on the weekly. So that's what I'm looking for next week on Adobe, is simply a close above the 200 SMA. That will be my entry trigger. Advanced micro devices. Well, I believed I spoke about this in previous podcasts when we were up here. I said, look, if AMD does get down to the 200-day moving average and reject it, I will get long AMD. I've been waiting for a pullback. Again, the value zones between this green line and this green line, anywhere in here is the value zone. Just by itself, buying in the value zone is a good idea. I really like that the 200-day moving average is in the value zone as well. If you would have been buying up here, if you would have been buying on all the hype and all the short covering, you wouldn't have done so well on this trade. Better to be patient, wait for it to come back down, identify that level. But this is a perfect example of why buy over the value zone. It's usually going to come back to the value zone. You get a better entry price. And again, all of these things is what I teach in my one-on-one course. So a close above the 200 would get me long. Let's take a look at the 200, about 79.20. Let's see what that looks like on the weekly. Weekly, that dovetails with this big up bar here. If it comes back to halfway, that's probably where it will find support. If we get over the 200-day moving average next week, we will also get back over halfway of this big up bar. So a combination, confluences of levels holding on multiple time frames. So AMD, close above the 200, that would get me long AMD. Amazon. All right. So clearly not a great place to buy up here. Way over value. Clearly we came into the value zone. Now I am looking for a V2 on Wednesday because Monday the market's closed. On Tuesday we have gone above the value zone. We've come back into the value zone. We are moving sideways. On Tuesday, we could have a potential for a return to value V2. Here is bar 1, here is bar 2. Bar 2 went below bar 1's low, washed it out. If and only if on Tuesday Amazon closes above bar 1's close at 98.15, that will get me long Amazon. This is a nice, beautiful setup. It could just go down, in which case I'm not in the trade. But if and only if on Tuesday Amazon closes above bar 1's close or closes above 98.15, that's a great entry point with a great trigger like a return to value V2. And so if we close above 98.15 on Tuesday, I will get long Amazon AMZN. Walt Disney, another perfect example of not buying above the value zone. Look at the people that bought up here. They must have really wanted Disney up here at 118. Well, now it's 115. Where am I looking? You guys have any idea? You're right. It's the 200. This gives me a level of support where I know people, large institutions, savvy traders will recognize that the 200-day moving average is a place where buyers will come in and has a good chance of holding. So next week, if and only if we have an intraday rejection of the 200, we go below the 200 and above the 200, that will get me long Disney. And the 200 here at 102, let's see where that dovetails on the weekly. I like it. On the weekly, right there where the 200 is on the daily, the weekly is the 20 EMA, another level of support. So that is a good entry and a good price, right around 102, a lot better than 118. So that's what I'm looking for next week on Disney, as a rejection of the 200. GLD, gold. I've been talking about gold for a couple weeks. This is the level that I have identified where I want to get long gold. It's the level of the 300 SMA and the 250 SMA, both dovetailing there nicely. And that's at about 168.70. Let's take a look at the weekly, see if we can find some support on the weekly at that daily level. Yes, 100 SMA on the weekly is right there. They line up perfectly. You're going to have a lot better chance of having a profitable trade if the level on the daily and the weekly line up at some support. So I've been very, very patient waiting for gold to come down to this level. And if you can just identify a level that makes sense to you, don't do anything until it gets there. It may never get there, and oh well, but if it does get there and it lines up on multiple time frames, that's where I'm going to take the trade, and that has worked out well for me in trading over the last 20 years. So next week, looking for a rejection of the 250 and the 300 SMA. That will get me long, and that level also dovetails nicely on the weekly at the 100. Google, G-O-O-G-L. Well, you know, I took this trade on the weekly right here with the rejection of the 250. And went up and up and up and up and up. Now, I got out right here, about right there, right near the top because of earnings. I don't hold through earnings. And it was a beautiful trade. I can't remember what that was, but it was double digit for sure. Yeah, it was like 22%. And getting out because of earnings I didn't want to gamble through earnings. And it could have just gone racing up and, oh well, right? You have to have your rules and stick by them. But our job as traders, our main job really, is being a risk manager, and holding through earnings is one of the biggest way to put yourself at risk, and that's why I got out. And thank goodness I did. I mean, I got out around 107. It's 94.35. But now earnings are past us. Look at the 200-day moving average here, or 200-week moving average. If we close above the 200-week moving average next week, then I'll have the support of the 200 underneath me, and I will get long on the weekly time frame on Google. I drew the line there at 95.51. Let's see what that dovetails on the higher time frame, the monthly. Yeah, 50 EMA on the month. You see how I'm looking for different support levels on multiple time frames? Well, that time frame on the weekly, if it gets above the 200, is going to get back above the 50 EMA on the weekly. So multiple levels of support. So with Alphabet, GOOGL, if we close above the 200, that gets me long Google, GOOGL, on Friday. Alternatively, if we head down, then I will also take a trade if we reject the 250, or if we really go down the 300. But you can see, look back in the past and look at the levels that have held. I bought Google here with the rejection of the 250, had a great trade. Bought it again here, the 250, had a great trade. Doesn't mean it has to get down there, and doesn't mean the 250 has to hold, but if it's held in the past, there's a better chance it will hold in the future. So two things on Google next week. If we close above the 200, that would get me long Google on the weekly. If we keep going down and we reject the 250, that will get me long from that level. And this would be my ideal level down here because it held so well the last few times. But if it does hold above the 200, I will also get in there as well. All right, Intel. Well, as I mentioned in my one-on-one courses, I teach 5 different trading approaches. This would be a higher low V2 if it happens on Monday. Higher low V2, we have to close below the -1 ATR channel. We have to rally into the value zone. We have to pull back and create a V1 or a V2. Well, this is formatted to potentially create a V2, but only on Tuesday. Here is bar 1. Bar 2 goes below bar 1's low. Tuesday, if we close above bar 1's close at 28.20, we will have a beautiful and completely legitimate higher low V2 entry. Doesn't mean it has to work, but they work more often than not in my experience. That's why I really like higher low V1s, V2s, and I have had such great trades this year on higher low V1s and V2s. So what I'm looking for Tuesday only is if we close above 28.20 to create a higher low V2. Eli Lilly, well, almost bought this on Friday. You can see this rejection of the 200-day moving average back here on the 2nd of February would have worked out well. You would have had a nice trade, lots of potential there for some nice gains. And now we have come back down hard. And Thursday, we lost the 200. Friday, I was looking to buy if we closed above the 200, but we never did. It did create a V1, but I want to have confluences of signals. I don't want to have a kind of conflicting signals. Yes, this V1, bar 1, bar 2, 2 goes below bar 1's low, closes above bar 1's close. That's a higher low V1, but I would really like to have the support of the 200 SMA below me. So next week, if we close above the 200-day moving average, kind of a nice gentle close. If it closes up here, I'm not going to buy it because then the risk to reward ratio is horrible. But if we have a nice gentle close above the 200-day moving average, it would give me a higher low. This low would be higher than the previous low, higher low. V1s, V2s, higher low closes above 30 RSIs, higher low closing above 200s, 250s, 300s. are always a better setup than lower lows. And I teach this in detail ad nauseum in my one-on-one trading course. But suffice it to say, higher low V1s, V2s, higher low anything breaks above the 200 are better because it gives you a better chance of a longer, easier leg up, where lower lows tend to bounce and then fail faster than higher lows. So next week, Eli Lilly, if it closes back above a nice gentle close back above the 200 SMA, giving me a good risk to reward ratio, that will get me long Eli Lilly. Conversely, if we head back down and reject the 250 SMA, that would get me long as well. Meta, well, Meta had really good earnings, popped up, and we've come back down ever since. Again, another good explanation of why not to buy over the value zone. My gosh, I mean, you're already down 15 or 20% if you decided that you had to buy up here. Well, now we've come back into the value zone, so at least it's at a reasonable level, and the 250 SMA is what I'm looking for. That's my entry point, some kind of rejection of the 250 SMA next week. It may not get there, and if it doesn't, then I'm just not going to mess with it. But if it does get to the 250 and rejects it or closes under and closes back over, that will get me long Meta. I drew the line at the 250 here, about 160, 210. Go to the larger time frame, the weekly, see if it dovetails with anything. Yeah, has the 50 SMA on the weekly below. So that makes sense from a multiple time frame perspective. So if and only if next week on Meta, we reject the 250 SMA or a close under, close over the 250, that will get me long Meta. But it's a good example of being patient and waiting for the price to come to the level that you want. And that's what I'm looking for, is a rejection of the 250. All right, last one here, Microsoft. You know, the market had this big, huge rally. And of course, I'm not going to chase this stuff. Like, I like to buy on weakness more than on strength. And, you know, Microsoft was just crazy up here, way above the value zone, just not a good place to buy. And clearly, in hindsight, it was not a good place to buy, right? I mean, here, still, I wouldn't have bought that. Then it went down, kept going higher. Well, if this high here would have been a good idea to chase. But ultimately, it comes back down, and you see how it ultimately came back down into the value zone, like it always does. Well, do you have any guesses of where I am looking to be interested in getting long Microsoft? Hint, there's a big black line. And there it is. There's the 200-day moving average. There should be some buyers coming in at this level. It would make sense. This is what I'm looking for. If and only if it gets to 200. Close under, close over, or a rejection of the 200. I drew the line here at the 200 to see how that dovetails on the weekly. Where do you see any levels that it dovetails on the weekly? May not be obvious, but look at the big bar we had here. Very close to halfway of this big bar. Just on the weekly, that should act as support. So my daily entry of the 200 there at 252 dovetails nicely also on the higher time frame. So next week, looking for a rejection of the 200. So I'm going to go through these again real quick. Apple, looking for a rejection of the 200 if and only if it gets down there. Adobe, looking for a close back over the 200. Advanced Micro Devices, looking for a close over the 200. Amazon, looking for a V2 entry in the value zone only on Tuesday, only if it closes above 98.15. Walt Disney, looking for it to move down, test the 200. Gold, looking for it to come down, test the 250 and the 300. Google, if and only if on Tuesday we get above 95.51, creating a higher low V2, I will get long Google. Intel, if and only if on Tuesday we have a higher low V2 and it closes above 28.20, that will get me long Intel. Eli Lilly, either a close above the 200 SMA Or if we go down, some kind of rejection of the 250. Meta, rejection of the 250. It's going to have to come down for that. And Microsoft, rejection of the 200. I really like these trades. You know, the market took off on us, and I didn't want to chase that. And I said, listen, there are some very obvious support levels here on the 250, on the 300s, on the 200s. These would make a lot of sense because big up moves come back down and they retest levels, and that's a great, these 200, 250s, these are great levels to test. Okay, let's get to the weekly setup. Oh, I should mention. So yeah, I showed you all the positions potentials here on the dailies. Now, if we have a big up day on Tuesday, then there's a chance that a good majority of these potentials that I'm looking at on daily are all going to trigger. Well, I'm not going to take them all. The rules that I use, or what I really try to do, is just buy the best setup of the day. So let's just say all of these triggered on Monday. Does it mean I'm going to buy all of these? No, because one, a lot of these are all tech related, and I don't want to have too much correlation in the industry, in the same industry. So my goal and my challenge as a trader every day is to look through the potentials of that day, look through all the ones, maybe 5 or 6 of them have triggered, but I want to narrow it down to the best one. And how do I do that? Well, I look for, I will take the position in whichever market has the most confluences and combination of signals. Maybe one has just a rejection of the 200, but maybe another has a rejection of the 200 and a V2, and it rejected the negative third ATR channel. And on the weekly, it was a V2. And on the weekly, it also rejected a major level. So I basically added up like a report card, and whichever one has the best risk to reward ratio, has the most confluences and combinations of indicators on multiple time frames, that's the one that I will buy that day. I like to pride myself on one position a day, the best trade of the day. All right, let's head over to the weeklies and see what we're doing here. All right, on the weeklies. Now, this is advanced micro devices again. Now, on the dailies, if we got back over 79.20 on the daily, that's legitimate. But as far as strictly speaking for a weekly trade, look at the 200. I would actually really love to buy advanced micro devices on Friday, next Friday, if we go below the 200 and close back above. I always like the lower price. But again, here's the line for the daily. Yes, if it closes over the 200, yes, I'll grab it. But if it doesn't and keeps going down, the next Friday, if we reject or bounce at the 200, I would buy AMD on Friday at the 200. We had this big, huge move up. It's normal to have some pullback, but I'll bet you that, and I could be wrong, but I'll bet you that there will be support down here at the 200, just like here. I mean, look at this nice little close under, close over the 200, and boom, right? So that 200 has been acting as support. Would make sense for a pullback to the 200 and buy the 200 right there. And let's take a look. If we're looking at the weekly, then I drew the line. What does the monthly look like? Well, has support of the 5 EMA on the monthly as well. So it dovetails on the higher time frame. 200 on the weekly, dovetail, that same price dovetails with support of the 5 EMA there as well. So that all checks all the boxes, make sure. So if AMD on the weekly goes down, rejects the 200, I really like it. Google, also on the daily, we talked about Google. If and only if Tuesday we have a higher low V2, but on the weekly time frame, if we were to come down here to the 250, I would love it. I talked about that a little while ago. You can see in the past that level, that moving average has been supported, and that's where I took my last trade on Google. I would love to buy it back down there again. Don't know if it will. Alternatively, if Google can close above the 200, I would also get long Google with the close above the 200 as well. So close on the weekly, close back above the 200, or if we go lower, rejection of the 250 would also get me long there. Nike, been talking about Nike for a while. I said if we can come down to the 200, that would get me long. I drew the line there, 116.30. Let's look at the higher time frame. Does that dovetail? Yeah, dovetails with the 10 EMA and the 5 EMA, so checks the boxes there. So next week on on Nike, if we come back down, if the market heads down again and we reject the 200, that would be a great pullback entry point with a good line in the sand of the 200. Oil. Well, I've been talking about oil for a while. Did want to buy it at the 200. You can see the last close over the 200 weekly. We've had some nice potential gains there. Are we going to get all the way down here to the 200? I don't know. But if it does, we're not only going to have a nice rejection of the 200 SMA, but we would also have a double bottom with the bullish divergence. You can see this low here with the deep red MACD bars. This is a momentum indicator showing that we've really come back down. We had to rally into some green bars. If we come back down, test this low, which in other words means that we're going to test the 200, I'm not even sure we'll have red bars. That's a double bottom bullish divergence. I learned this by studying one-on-one with Dr. Alexander Elder. He feels like double bottoms bullish divergences are one of the strongest technical indicators that there are. I agree with him. They are very, very strong. Only thing is they don't happen very often, but this has the potential of happening. And I love that we would have a double bottom and a bullish divergence at the same time we rejected a major moving average like the 200 week moving average. And then I drew the line here at the 200, 61.70. If we go to the higher time frame, we still have the support of the 50 above. XLU. Well, again, just waiting for it to come down. If it comes down, rejects this 200-day moving average, I would love it. Not only would it be a rejection of the 200, it would be a higher low rejection of the previous one. And that's what I really, really like about that. I don't know if it's going to get there. It just created a higher low V2 here. This one may move up. See, bar 1, 2, 3, 2 goes below 1, 3 closes above bar 1's close. But if it does come down and rejects the 250, be interested in anything wrong, long XLU. And then XLV Healthcare, okay, we were above the value zone. We returned to the value zone. We have some sideways motion. This is a different strategy. This is the potential to set up for return to value V2 next Friday. Here is bar 1. Bar 2 went below bar 1's low. If and only if next Friday we close above bar 1's close, which is 132.49, it would give me a nice return to value V2. So, as I mentioned, I teach 5 different trading approaches. I teach a deep dip buy strategy, which involves the 250, 300, 230 RSI. I teach a return to value V1, V2. I teach a higher low V1, V2. I teach moving average crossover approach and also double bottoms, bullish divergence. And these are all the things I teach in my one-on-one course, and I will teach you step by step all the rules. And there's a lot of rules. Like I said, in this particular podcast, I go through and kind of tell you what the rules are. And you might think, oh man, how would I ever keep those all straight? Well, if you do the trading class with me, you will keep them straight. And I promise you'll be glad you did. So on XLV next week, looking for a return to value V2. So just big recap, XLV, we have to close above 132.49 for the return to value V2. XLU on the weekly, looking for a rejection of the 200. USO, also looking for rejection of the 200. Nike, rejection of the 200. Google, either a close above the 200 next Friday or a rejection of the 250 next Friday. And AMD, just if we keep going down and reject the 200 SMA. So I really like these setups for next week. I really do. Let's quickly take a look at the markets in general and some supporting markets to see what's going on. Here are the cues. We had the big kind of short squeeze and the Powell rally and so forth here. What concerns me about the Qs here is we have made a lower high. We have not made higher highs anymore. You see how we have this high here? It's lower than this high, lower than that high. So we did bounce on Friday at the 20. So it's hard to say the direction of which way we're going. But what I don't like on the Qs is that we have made lower highs. So I wouldn't be surprised if next week we keep going down. Let's look at the SPY, also lower highs. So that's a little concerning to me. More of a bearish case. On the other hand, we're back in the value zone, which might lead to a move up. So it's a little difficult to say. Dollar thing that's a little concerning about the dollar at the moment is negatively correlated to the market, meaning that the higher the dollar goes, the more likely the market is to go lower. And we have broken out on the dollar. So that's a little concerning for the bulls. But on the other hand, we've rejected this 250. We had a big reversal bar. So that may be positive short term for the market. I guess what I'm saying, if I have to be honest, I think short term we could bounce, but I think longer term, I think we're going down because of this breakout of the dollar, which is negatively associated. Another thing to take a look at, bonds. Well, bonds have been coming down. TLT have been coming down. Bonds at this moment are also negatively correlated to stocks. The more bonds come down, that means interest rates are higher, more likely that the market will go down. But we had a reversal here on Friday on bonds, just like we had a reversal on the dollar. So I guess I would say my short-term outlook on the market, and I mean a day or two, may be up, but because of the rejection of the 250 on the dollar and on bonds that we've moved up, that's a little positive. And then VIX, of course, big kind of reversal bar on Friday on the VIX, which is short-term bullish for stocks, but long-term the VIX has broken out, which I believe is long-term bearish for stocks. And that's why I have been putting on some VIX positions. That's why I have been taking some short positions. Because the technicals have told me to, but looking at the bigger picture of making lower highs on the indexes, breakouts in the dollar, breakouts in the VIX, the bonds moving down, short term, and I mean a day or two bullish, but longer term, I am definitely bearish on the market. So I know I've been talking a lot about my one-on-one courses. I think it's one of the best courses out there if you really want to learn how to trade like a professional, like myself. I think the best way to learn anything is one-on-one with your instructor or your teacher. Have that kind of intimate connection and being able to ask as many questions as you want. And that's why I provide these one-on-one courses. I just think it's the very best way to learn. I'm extremely patient. You can ask me the same question 118 times and I will explain it to you 118 times. But I love to teach. I think there's so much value in this course. Like I said, I've taught so many people from all over the world. They've always told me they're so glad that they took the course. The course is $1,750, so it's not inexpensive, but it is worth every penny in what you are going to learn. So if you are interested, my email is in the link of this YouTube video. Just send me an email, say, Greg, I'm potentially interested in taking your course. I'll reply and say, great. How about we set up a Skype call? The Skype call is free. It's not a sales call. I promise you that. I just want to learn more about you, what you're looking to learn, what your trading challenges, your trading goals are, and see if we make a good fit as far as teacher and student. And when we're done with the call, I will not ask you if you want to take the course. When we're done, and you're going to have to reach back out to me after the call if you want to start. And I hope you do, because you're going to learn a lot. It's going to be worth the money that you spend for it, and you'll be glad at the end of the day that you took the course. So if you're interested to start the process, just send me an email. Email's in the link of the description. If you like online courses, I have a great online course where I teach you step by step the deep dip buy stock trading strategy. I have sold so many of these online courses. I've had so many good reviews, so much great feedback from people. And, the one-on-one course costs $1,750. I mean, it's the best way to go, I promise you that. But if you want to start with the online course, it's only $12 or $15 on Udemy, and the link is in the description of this YouTube video. And that course, very inexpensive, but don't let that fool you, because there's 9.5 hours of video in there. There are 15 study guides. There are 26 videos, and you are going to learn a ton from that online course. And it's very affordable, 12 or 15 bucks. So if you're interested, the link's in the description. If you like today's podcast, I would really appreciate it if you could hit the thumbs up button and or share on social media. Hitting the thumbs up button really helps with YouTube. Let YouTube know that there's some valuable content here. So if you did find something useful today or in previous podcasts, I would just ask if you could hit the thumbs up button before you get on with your weekend. I would certainly appreciate it. And then last but not least, but most important, please try to go out and do something nice for someone today. It would make the world a better place if we all did one nice thing for another human being. It would just make the world a better place. You like it when someone does something nice for you. Go out, do something nice for them. You never know what kind of day they're going through. You don't know what's going on in their life. Just simply holding the doors, just simply giving a smile could be the difference between them making it through the day or not. And if you could also do that for an animal, I would really personally appreciate that. Animals like acts of kindness just like humans do. So, I try to do one nice thing for another human being each day. I try to do one nice thing for an animal each day. And, hopefully if I need it one day, they'll be there for me as well. But, you don't do it to think that you're going to get something. You do it just to be good and to make the world a better place. So I hope you've been trading well. I hope you have a good long weekend. Monday is President's Day, so the market's going to be closed. So we get a little break. I'm doing an interview next week with Michael Lamott. He has written a new book that we're going to be discussing, and so I'll be posting that. I'll post that on social media. But he's a really smart guy, great author, great trader, great mentor, and he wrote a book on trading psychology. Very, very important. So look forward to that next week. So thanks again for your time, everyone. Appreciate you being here. Appreciate you investing the time. I hope you're learning something useful. And if you have any questions, leave them in the comment section of this YouTube video, and I will do my best to reply to them. All right, so take care, everyone. Have a great one. And on the way out here, I have to run the U.S. legal disclaimer. Okay, we'll see y'all next week. Take care. Bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.